Thank you. Mr. Marchant's recognized.
Thank you, Mr. Chairman. I represent a district that basically surrounds the DFW airport. So I have a very small geographical district. So when you land at DFW airport and you begin to drive through my district, you see the corporate headquarters of not Ford, but companies like Exxon and Fluor and these multinational, and you begin to get the impression that this is the main driver, business driver in my district. But the truth is, it is the small manufacturing companies that have gravitated there near the airport, near the multinational companies, that are there basically to serve the needs of, to supply these larger companies. When you begin to talk about taxing incomes over $250,000 at a higher rate, you're not talking about really taxing the large multinational companies. You're talking about taxing those small manufacturing companies who rely totally on retained earnings to fund their equipment purchases, your grinder, to fund new jobs being created, the 3 positions that will operate that grinder, and you're talking about the physical expansion of their plant facilities. All of these companies use their retained earnings to do that. If you raise the tax on those retained earnings, additional 5 or 6%, that the direct result of that there will be 5 or 6% less money put into facilities, equipment, and new job creation. So it has a very detrimental effect on it. And it's really to the advantage of the big companies who rely very heavily now on just-in-time inventory, rely on the efficiency of the smaller manufacturing and the smaller and mid-sized companies that are out there that are providing all this. So I believe if you begin to target what I would call the job creators in any kind of a tax reform or any kind of a tax extension, that you will eventually end up driving costs higher at the large company level. Now that's my comment. My question to all the companies here is, since an increasing number of targeted business tax expenditures are enacted on a temporary basis, is there greater value in a permanent tax rate reduction than these temporary benefits that must be renewed by Congress every year or so? And I'll start with Ms. Dawson.
I think that's undeniable. It would be far better to have a stable system that would inform good decision-making. That's what we would hope for.
Thank you.
Just one word, absolutely.
I would agree. I think the temporary provisions are particularly painful. Corning in particular benefits from the look-through as well as the R&D credit, and having those bounce temporarily is very troublesome.
Again, uncertainty, I think I've used the word about 10 times so far. It makes it very difficult to plan when you have all the things on your mind as a small business. I believe in a stable, longer-term environment is what we all need. I would also, however, state that I also agree that if there's anything that can be retained or implemented to encourage investment in our country, to encouraging people to get into manufacturing, stay in manufacturing, should be considered.
I just think a stable tax is the best tax. I probably lean more a little bit the other way. If you had a lower tax and you had to give up some of these other things, at least we know the playing field that we're playing on. But the other opportunities of faster depreciation and R&D tax credits, those certainly are incentives for manufacturers, and we certainly appreciate those opportunities to do that. But at what cost, how it comes out in the committee, you know, I think the stability to me is still the most important thing.
In a capital-intensive business like ours, where it takes typically 2 to 3 years to build a plant, understanding what the tax result will be when the plant is finally placed in service 2 or 3 years down the road, and the predictability of that is a huge advantage and a game changer, I think.
I'd like to point you to a couple of citations in my testimony about what lowering the rate in a revenue-neutral way would do to a variety of industries. So that would lead to the elimination of many of these deductions. And there's some work by an economist named Martin Sullivan who showed that if you reduce the rate in a revenue-neutral way, this would be most detrimental overall to domestic manufacturing in his analysis, and that the biggest winners would be securities, who would see a net reduction of 12.3%, insurance, credit intermediation, and retail trade and bank holdings, so that reducing the rate overall but eliminating these deductions would primarily go to finance and retail, while overall it would mean a net in aggregate increase for manufacturing, and in particular computers and electronics would see the largest increase in their taxes under that proposal. So I do think that it seems to be there are some concerns.